Welcome to Willis Weighs In, where we discuss controversial and newsworthy tax planning topics. I'm Ben Willis, contributing editor with Tax Notes. Today, we're going to be talking with Monte Jackel. Monte is of counsel at Leo Berwick. Monte assisted Senator Wyden's staff in an unofficial capacity in drafting what we're talking about today, which is subchapter K reform and the proposals recently released. Monte is a busy person, and so please forgive any interruptions in today's conversation, phone calls, etc. Monte, thank you so much for joining me today.
Sure, I'm glad to. I guess we can just start to dive in on this in terms of on September 10th, these proposals were introduced, seemingly out of the blue, although as I understand that the staff was working on these for a while. But I'm not aware of any specific, this is the same thing I recall saying when the partnership anti-abuse rule in 1994 was being worked on. I do not recall any specific transaction then, and there was none now to my knowledge, that triggered the need to put these proposals out. It was more in response to the general environment in terms of the inability, for many reasons, funding, lack of funding, lack of trained expertise on the part of IRS examiners, neglect over a period of time, or just due to the fact that the large accounting and law firms just have a very extensive body of technical expertise, and partnership provisions, due to lack of enforcement over the years, has led to kind of a dearth of authority in terms of issues and areas which, unlike the corporate tax area, for example, there are a lot of areas in the partnership world where there is no clear answer. So you can have practitioners, very skilled practitioners, working on very, what would seem to the casual observer, minute issues, but they're pouring in huge resources in terms of working these problems out. And you can't say that the positions that have been taken are, tax gap in terms of not reporting income types of things. So the types of issues that are gray area issues. And there have been a lot.
Let me stop you there for a second, Monte, and just say, so when we talk about the tax gap, we're talking about making sure the taxpayers are in compliance with their legal obligations, their liabilities. But I think what you're saying, just so I understand it correctly, is that it's oftentimes impossible to tell in the subchapter K space, in the partnership space, what those liabilities are, because they're so gray, they're so amorphous, they're not concrete and in the code. They're often through these regulatory grants of authority. And that just makes it trickier to actually enforce the law because the law is so unclear. Is that right?
Well, yes. I mean, it's due to the fact that oftentimes issues are gray, and in the process of working these issues out, you can have those on the more aggressive side, those on the more conservative side, but there's a clear recognition, I would say, throughout the entire tax bar, that these most technical, if not all technical, partnership tax issues are not audited, not today. That may change soon, but as of now, they're not. And the law is when enacted in 54, the law was designed to provide equity, simplicity, and flexibility. Those were the three things that were mentioned in the legislative history. But at that time, you had general partnerships, a few maybe limited partnerships, but there were no LLCs. There was none of that stuff. Now there's a huge amount of entities out there having partnership form, raising all sorts of issues, where judgments are being made, affecting a huge amount of dollars, and which are not examined. And although an attorney's ethical obligations are not to assume there won't be an audit examining an issue, everyone's human, you have that in your mind. And so the knowledge that there have been and are arguable abuses, which I would categorize as just aggressive interpretations of current law, certainly not illegal, but either aggressive or clearly not conservative, where there's not a clear answer under the law, where even if you wanted to, you couldn't get an IRS private letter ruling in terms of an issue if you wanted to, and the inclination would be not to seek them. And because of that, there's enforcement issues. And so for the large corporations, and they're frequently partners in partnerships, whether they're internal or whether they're external. And for that reason, not examining partnerships has a large impact on corporate tax revenue.
You mentioned the legislative history. I couldn't help but think, I know I've been a strong advocate that the IRS can't deprive taxpayers of congressionally intended benefits. And so when you talk about this flexibility that is inherent in subchapter K from 54, and then all these regulatory grants that really are the crux of subchapter K, it seems like the IRS is really faced with a big hurdle when it comes to auditing them, since it's not clear what so many congressionally intended benefits are or are not. And so this flexibility that is the theme throughout subchapter K seems to be what is most often taken advantage of in tax planning. Do you think the IRS has an impossible job in trying to audit and enforce some of these things without more aid from Congress?
Well, without aid from Congress, even I would say that without a reform of the statute, some of the statutes in subchapter K, that the ability of the IRS to effectively audit current law, even if the resources were ramped up in terms of auditing functions and hiring more examiners, which I understand that is happening, and also increasing the visibility of the chief counsel function in pass-throughs and special industries in terms of perhaps having a separate division that would be governing partnerships like corporate tax, which doesn't exist today. But even making all those reforms changes, I think it would take at least a decade for the government to be competitive with the private sector. Otherwise, right now you'll have audits, you'll have 469 audits and in partnerships, and you could say that's a partnership issue. But when you move away from an issue like that, there's very little coverage, and an examiner will know that if it's one of the big boys who are being represented, that they're going to have to spend a huge amount of resources in terms of going after a particular issue, which may or may not get litigated, and so on and so on. And so there needs to be some reform, because the main issues over the years, and by the way, this is not the first time, unlike some of the criticism that's come to the Wyden proposals, that more time is needed to study them. The truth is, at least as I see it, is there was an impetus to push for reform in the early 1980s, in the early 1990s, in the early 2000s. There was a large amount of literature written by any number of very qualified people proposing all sorts of reforms, and nothing was done. I mean, except that at the edges. I mean, the last major, if you can call it reform, in subchapter K was in 1984, where principally 704C was made mandatory, and some other changes were made. But the main issues that have existed for years now, when you move away from the what I would call simple time in 1954, when the sub K was first put into the law, you have issues dealing with contributions to the entity partnership, the operations of the partnership in terms of both allocations of income and losses, as well as allocations of debt that has an effect on your tax basis, and then on issues relating to distributions of money and property out of the partnership to the partners. And in the case of contributions, there's been since the early 90s flexibility in terms of 3 named reasonable methods to apply Section 704C, which principally deals with making certain that the partner putting in appreciated or depreciated property gets allocated the gain or the loss as appropriate. And there were 3 methods, none of which were mandated, what they call traditional, curative, and then remedial. The traditional method was just one where you would try to give tax benefits, move them to the non-704C partners to the extent of the non-704C partners' economic interest. And then there was a curative method that allowed you to take other items and make it so that the book tax disparity, meaning the difference between the fair market value and tax basis of the contributed property, ends up at the end of the useful life of the property as being 0 for both book and tax. And to the extent that that doesn't happen, and if the property can leave partnership solution without a current gain being imposed or loss being imposed, and the basis that that property takes with it changes the amount of the gain or the loss that the distributee would have or the remaining partners would have, there have been problems ever since subchapter K was enacted, principally dealing with the 704C going in and then the operations of the partnership and allocation of gain, loss, and debt, and then exiting where current law allows, with one limited exception, current law makes it optional to adjust basis of partnership properties to other partnership properties that are retained. But there are many circumstances in which the shares of gains and losses are altered by virtue of distributions of property in kind. There are cases where when you're allocating income or losses to partners, to the extent, right now there's what they call a substantial economic effect test in the regulations, which looks to whether you're maintaining capital accounts properly, whether you're liquidating based on capital accounts, and if you have a deficit at the end, you'll restore it. Right now, a larger number of practitioners are using what they call waterfall distributions and targeted allocations, whereby the partnership agreement tries to get the capital accounts to equal what you're going to distribute in money or property. But if not, what you're going to distribute in money or property is fixed. You're going to get the money. I mean, if capital accounts are not where they should be, you're going to get the money regardless. And so, which is then policed by a standard in the regulations, for which there's very little guidance, called the partners interested in the partnership rule. And so some have argued for a number of years, and it's undoubtedly true, that the current regulations in the Section 704B dealing with these types of allocations are very complex. And although there are some partnerships that need to use a safe harbor, like, for example, tax credit partnerships, which have flipping allocations and need to otherwise be in compliance with 704B in order for the safe harbor in these tax credit rev procs to say that the allocations of these credit partnerships are good, they need a safe harbor. So when the Wyden proposal proposed repealing substantial economic effect and imposing PIP, partner's interest in the partnership test, the idea was that since most were using what the economics are, meaning PIP, that could be the default rule, and that could lead to a simplification of the regulations under 704B, which are quite complex, as I said. On the other hand, there are a number who admittedly relied on current law, meaning the 704B substantial economic effect test, in structuring their operations, and there are issues dealing with effective dates and pre-enactment agreements, which I know the staff in Congress is well aware. So that the dates in the version of the legislation that was proposed are not, as I understand it, fixed, carved in stone, that there's a recognition that no matter what happens, if there's a change, you need to have a sufficient grace period to it. And the other point with the 704B allocations has been that among related parties, however you're going to define that, related party partners, they essentially will act as one single entity because there's one economic pocket when you get done. And so the substantial economic effect test, which says your allocation is okay, your special allocation is okay, as long as someone could be worse off, because you know someone's going to be better off. If you examine those situations partner by partner, you're going to see that there's no problem and the allocation is good, and yet no arm's length unrelated party would arguably enter into such an arrangement. So the Wyden proposals have a provision that in those cases, and you can argue about what's sufficiently related to trigger the rule. Right now, there's a very limited provision in there with control group partners. Some have argued that the degree of relationship is too low, that the provision is both over-inclusive and under-inclusive. But the point is that in those cases where you have sufficient related party partners with sufficient control in the partnership, they should basically be treated like S corporations in the sense that the allocations would be proportionate to capital.
I've got two questions that stem from what you just said, just to backtrack a little bit. It sounds like there is, and I have some familiarity with this, of course, not as much as you, but incredible complexity with determining substantial economic effect. And I guess one could argue that some of that is inherent in the flexibility that Congress intended when originally creating that. I guess my question is, if we switch to a PIP, a regime where that is the general rule, except for some exceptions, of course, would PIP, which is currently very unclear, undefined, would that effectively become what is now substantial economic effect? In other words, would the regulations grow to the point that they allow so much flexibility to implement Congress's original intent that they largely look like the current substantial economic effect rules?
Well,
and their complexity?
You would need, in order for the mandatory, let's say, application of PIP, or as a favored method, however you want to view it, to actually meaningfully police the landscape, you'd have to have audits, you'd have to have more detail in terms of the economic factors looked to. You'd have to have more examples in the regulations of various arrangements. But and for non-controlled partnerships where parties are presumed acting at arm's length with a diversity of interest, for non-controlled partnerships, that should be fine. if there are abuses, the government can tighten it up in regs, but right now there's a lot of complexity in the 704B regs and trying to meet the safe harbor. And in many cases, the safe harbor in the regs is not met because you're not liquidating in all cases based on capital accounts. And since a number of partnerships are not liquidating based on capital accounts, a number of the rules and the current regulations are not necessary. Now, that could mean you leave the current law as is, but you substantially reform the 704B regulations, such as perhaps removing the value equals basis presumption that's in the regs, along with some other rules that are in there. And you otherwise leave substantial economic effect alone, but you also need to provide much more guidance in terms of what the partner's interest in the partnership standard is. But most important above all is policing the allocations among related party partners. Now there are legitimate arguments in terms of what kind of relationship, both between the partners and between themselves and then between the partners and the partnership, is necessary to trigger a concern in the rule. But the government, despite prompting at many times, and the last time the government itself promised in 2015 as part of the 721C regulations that were going to be issued, they issued a notice in 2015 with detailed issues that would be addressed by regs dealing with the application of Section 482 to partnership allocations. That was never done. And you could say, well, there's a lack of comparables and therefore it wasn't done. And that's a complaint I often hear. But the point is that you just cannot allow flexibility in terms of deviating from a pro rata capital allocation in controlled partnerships. Now, there would have
and just so you know, I'm not knocking the idea. I'm simply saying I actually like the idea of wiping the slate clean with respect to the 704B regulations, pulling out some of the provisions that were historically used for abuses, and I think we've seen those issues arise over there, even in the last 5 years or so. But it's more of a warning to say I believe PIP could become like a substantial economic effect. In fact, some people view PIP as needing to look to substantial economic effect in those examples in order to even to figure out what it means and how to interpret just a few factors that are found in the regulations.
Well, candidly, when you really get down to it, the changes with substantial economic effect and what's being proposed with that, meaning repealing it, it's not what I would call critical. I mean, it would be a laudable objective, but it's not critical. What is critical is that since there just are not going to be regulations under 482 applying to partnership allocations, there are a number of abuses that occur among partners that are related, however you end up defining that, and that needs to be policed. And there's no way to audit those effectively.
Great.
And it will take too many resources and there are no comparables. So you have to have a hard and fast rule. That's that I firmly believe in. When you then get to another component of the overall Wyden package, there was a requirement to impose remedial allocations, the third method I talked about earlier, on all forward and reverse 704C allocations. I mean, forward allocations are just you contribute the property into the partnership with a built-in gain or a built-in loss. The reverses are when you have changes in the interests of the partners, generally speaking, and there's been a change in the value of the properties of the partnership between initial acquisition and the later event, so that the appropriate economic sharing of the partners is maintained. And under the current regulations, these revaluations are optional, although the regulations warn that if you don't do them, you could have assignment of income or other issues. the proposal would make them mandatory. It would also require revaluations. Not only would revaluations be mandatory, but if there were tier of partnerships, to the extent that the upper tier controlled the lower tier, more than 50% or whatever threshold will be picked, those would be required to use to revalue their property as well. And why is that necessary? Because if you have a property that's contributed to a partnership, and then that partnership contributes it to a subsidiary partnership, there's all sorts of problems that are created and too many opportunities for abuse. Each partnership can choose its own 704C method under the current law, and that needs to be controlled. And the only way to really police it is through making revaluations mandatory, along with the remedial allocations, which ensures that until the property is distributed, the book tax disparity between the partnership properties will be eliminated gradually and until either its useful life expires or it's sold. Now,
could Treasury and the IRS effectively eliminate this concern relating to built-in gain and built-in loss assets in 704C by tightening up the rules relating to the revaluations and the flexibility that is allowed through RevProcs and other procedures?
well, they could do that, but the problem would be that, first of all, the small businesses, small partnerships, however you want to describe it, it is undeniably true, because this has been one of the complaints about the Wyden proposals. The principal complaint has been that the small businesses won't be able to comply with the complicated rules in terms of every time there's an economic change of partner interest, there's a revaluation, a hypothetical sale of the partnership properties at fair market value. The properties may not be publicly traded. Of course, it could be non-public interests, which are difficult to value in a hypothetical sale. And then through tiers of partnerships, the burden imposed on small business could be immense. And I agree that that's true. But I also very firmly believe that for the larger, more well-advised partnerships, whatever threshold level you pick, for example, 5 million gross receipts, 25 million, which is the current rule under 448, or whatever level you would pick, that those who are below the threshold would not be required to follow these more strict rules. I mean, those areas where the larger partnerships are involved, they're more than adequately represented, and therefore there is no reason that these more accurate but burdensome measurements could not be done by these, any of the big four, the mid-level accounting firms, the large law firms. And when you do this, when you require remedials, when you require revaluations, along with, as we'll talk about in a moment, mandatory adjustments to the basis of partnership properties that are distributed under a new 734, you're eliminating many of the gain shifting, loss shifting, and value basis disparity creating issues that arise and have been written about extensively in the literature, which leads to much less flexibility, yes, but also makes subchapter K more functional. But the cost is flexibility, yes. And the question that I understand is presented by that is, once you carve out small businesses from being mandated into the rules, they could also always opt into them, but not being required to follow them, then you get to this question of, is there some vested interest on the part of the taxpaying communities that a statute or statutes will not change ever, and therefore, even as response to changing times, or can, with appropriate transition and pre-enactment rules and exemptions, can you not change the law as appropriate to fit circumstances which are proven to be needing change? And I was in favor, and still am, of these proposals because I think the law needs to change in reaction to changed circumstances, as long as the burden is not too great on those who would have difficulty complying. And so,
let me just say, I really agree with that point. And I know that a lot of the people that are coming out right now against some of these proposals because of the complexity are the ones who sell themselves because of their ability to handle complexity. And so to your point, some of the big boys out there, the big four, these big firms that thrive in the complexity, that handle this stuff, that love this stuff, are the ones who are pushing back. And perhaps, you know, they're looking for the lines in the sand where they want to see exactly where the small partnerships are going to be exempted and how that's going to work and some of the complexity there. But overall, I'm with you, and I can't help but think that some of the abuses that these proposals would eliminate, or potential abuses, I shouldn't say abuses, because again, this area is so uncertain, but is driving some of the pushback against this legislation overall. But as far as closing the gap, and the goals aligned there, they certainly seem to be aligned with a lot of the goals of those in Congress and the administration.
yeah,
So
because you get complaints like, for example, you can get industries that are formed around a particular tax rule. Let's say with carried interest and private equity, for example. And there would be economic harm created by virtue of changing the tax rule. And then the issue becomes, when the proponents of change get the complaint that you're going to cause economic harm, but the industry formed around a particular rule, does that mean the rule can never be changed? Now, yeah, you have to balance things when that happens, but I'm just one who believes that you're with a reasonable transition period and reasonable exceptions, that the law can be changed to match changed circumstances. And just like with the mandatory 734s, on distributions, the Wyden bill had proposed something close to, but not quite the same as, a partial liquidation approach for partnerships, where you'd actually be treated as having separate economic interests in the partnership. And so when you get a distribution, it would be measured in relation to the basis of that interest, separate interest. It would be measured much more accurately than the current rules, which have 734 only applying to the common basis of partnership property, applicable to all partners, and the adjustments being optional for the most part. What's being proposed is a hypothetical sale of the properties of the partnership, both before and after a distribution, so that the shares of the partners in gain and loss properties are not altered by virtue of, they're not shifting by virtue of the distribution. And because of that, you get a much more equitable treatment. But on the other hand, the burden imposed on small partnerships, the taxpayers, could be significant by doing that. So again, just like with mandatory remedials, mandatory revaluations, you can make the case for, you really do need to have meaningful reform. You really do need two separate regimes. You need a regime that, because I don't see any other way to do it. To address legitimate taxpayer complaints, you need to carve out what you would call small partnerships. To address the abuses, you need to have very tightly drafted rules. And in order for that to happen, Those are applied to those who are capable of understanding and applying the rules and defending themselves in court. And you need that type of system because particularly when you can have like multiple changes of interest of the partners during a single tax year, and then to look to see what the properties would be if they were sold, and a number of the properties, if not all of them, are not publicly traded. And when you have all of that coming together, it could be burdensome on small businesses. And I agree that there needs to be a carve out for those who are not capable of doing the computations. But what I refuse to accept is that those entities who are very well represented and know the rules inside out and can comply with as much complexity as there is, in fact, they would love it, that to say that you should not change the law because some others won't understand it. Well, that's been true for regulations and statutes that have been issued over the past, multiple decades. And so I viewed it as unfair criticism that it's fair to say you carve out those who are small in the sense of not being able to comply reasonably with more severe requirements, but I don't accept the fact that the larger entities could not fully comply, and that areas of law which are difficult to understand, for which there may not be adequate guidance, of which you could name any number of things, and there have been many good articles written on those topics about shifting gainer laws or the order in which you have sales or redemptions. All these difficult rules can be either worked out in regs or they'll be litigated, but those who understand the rules and are capable of complying should have to at least have tighter guardrails placed upon them, because otherwise there'll be no end to this. There'll be no end to it.
I know we're getting a little bit close to time, so I can't help. I know folks are interested in our interest deduction limitation, the difference between the Wyden and the House proposal, and just why we have the rule that we do. I know you and I have talked about aggregate entity issues and kind of where we landed. Could you tell us a little bit about that? Under 163J.
And I need to be careful because one of the folks I work with from time to time spent a significant amount of time while at chief counsel working on these 163J rules to partnerships, which currently provide that the interest deduction limitation is imposed at the partnership level. That in and of itself has added a huge amount of complexity to the regs, undue complexity, actually. I was one who maybe advocated too strongly for the fact that it was a marvelous effort on the part of the drafters of those regs to actually get something out that at least was in English that explained the rules, but way too complicated. Not even for the most sophisticated practitioners, very burdensome. Okay, not that they had a choice. I think they did the best they could with the statute, and I think it was a mistake. What the Wyden proposal would do is it would effectively make the limitation uninterested. It would basically say that any items from the partnership that are not needed to deal with partnership issues like excess taxable income or excess business interest income, that you couldn't use those items to offset the partner's other attributes ever. And that's the gist of it would limit it to a per partnership thing until there was no partnership, basically. That is not much better, I think, in what's already there today.
The current law under the TCJA focused on the partnership level, right?
Yes, and that's what creates the complexity, but attempting to keep that regime, but limit the ability to effectively a partnership by partnership determination of the results under 163J, I don't think improves things much either. And the House bill under the proposed BBBA, if it's a Build Back Better Act, would do a much better job of it. It would do what the statute should have done all along, which is apply the limitation at the partner level. Pure aggregate, no entity, just aggregate. Now, with the catch, and the catch, but it was logical, the catch to it, which would be that once you said the limitations applied at the partner level, you have this question of, well, that means if the partner is a small partner under the 448C definition, it would be exempted under 163J3 from the rules, generally speaking. And but that does not answer the question of what do you do in situations where what's being allocated to the partner is from a partnership that is large or not small, meaning, and so that was pointed out to them, and so they made a clarification that essentially says if you have an allocation from a large partnership, meaning not a small one, measured in terms of the gross receipts test, that the 163J would be applied at the partner level, and the partner, even if it was a small taxpayer, would not be exempt. It would only be exempt for allocations from a small partnership. But that's logical and would probably make the absolutely confusing, complicated application of the rules, and particularly what they call the 11-factor horror show coming from the regulations about how you compute the limitation, all that would be moot. And so you would basically have mass simplification, which is what it should have been all along. So what the Wyden proposal is trying to do is basically make it a partnership by partnership computation, but really not otherwise simplify things. Excuse me. Whereas the House proposal would just eliminate those constraints and just say applied at the partner level where it should have been all along. And I think there's a lot to recommend that. And then I just wanted to, since we have any time remaining, I just wanted to briefly mention in the corporate, there's a corporate minimum tax that's being proposed. I always had this question of how will a large corporation treat its interest in a partnership when certain partnerships can either themselves be subject to FASB, auditing standards, because you could, for example, view the centralized partnership audit regimes imputed on the payment as a tax directly on the partnership, or you could view it as a withholding tax on behalf of the partners. And then you have different ways to treat partnerships by partners. If you, completely control the partnership, I understand it's consolidated with the partner, or if it's just, significantly controlled by the partner, then you use what's they call an equity method, which is basically taking your distributive share of the partnership items into account. It's not at all clear how to apply those rules, even under the proposed statute as amended. And I'm not advocating for one position or the other. I'm just arguing that much like the 2 or 3 years in the late 80s when there was a earnings tax, adjusted earnings tax upon corporations that got repealed, that at least people on the drafting side with their eyes open look at and make certain that you cannot continue to play games with positions on partnership tax returns that will result in circumventing the intent to impose a true 15% tax on large corporations if in fact the bill passes. And other than that, I don't think enough attention has been paid to it. I think there's a large amount of corporate income that flows through to the corporate partner from the partnership, and that you need to have clear eyes in terms of how those rules will work before you sign the thing into law, and not leave it to Treasury to figure it out. Because traditionally, what's happened over the years is a provision such as that, partnership provision in the corporate minimum tax, would get very little attention. And so the concern is that if that's the case, you'll be back to where you started from. You really won't have a real minimum tax. And so what I think, if I can summarize it, is I agree that burdensome rules should not be imposed on taxpayers who are not capable of complying with them, and that would be unfair. On the other hand, those who are well represented, either internally or externally or both, meaning large corporations, medium-sized corporations, however you want to describe it, those entities, due to the vagueness of the current rules, sufficient guardrails need to be put up to keep the system in check and to reduce to at least compensate someone for the fact that the Internal Revenue Services cannot audit them, whether it's because of resources or expertise at the current time. I mean, you just can't. And because of that, changes need to be made. Now, it doesn't look, speaking today in mid-November, it doesn't look like any partnership reform is on the immediate radar screen. Frankly, that could be a story in itself in terms of the things that Congress decides to pick as revenue raises, and those it doesn't want to pick or doesn't understand and doesn't want to pick it because they don't understand it. And I put the Wyden partnership proposal in the latter basket. I do not believe that what the discussion that we've had has been adequately communicated to the public, either the public at large or to so-called mainstream tax reporters who report out tax news to the press, or even I haven't heard or seen yet any really balanced overall discussion of these issues. I've seen plenty of criticism of these issues, but it's completely understandable if you view things with the lens of self-interest as well as favoring the status quo. I'm not sure that I would be in favor of, if I was working currently for one of the large accounting firms, as I've done in the past, but I would not be permitted to come on and talk to you about this in such a manner because it just would be bad for business. And you could lament about having so many qualified people in these large firms who cannot speak the truth in terms of they would love to, but they can't because of economic self-interest and economic preservation. Can't fault them for doing that. On the other hand, people need to keep their eyes clear and open to the fact that that is why you're not getting a lot of vocal public support for a number of these proposals, because people who are in the know for the most part won't say. And so, I would just ask that people look at these provisions fairly and then I think with appropriate carve-outs, as I've mentioned, that this system will work a lot better. And the more that can be done by Congress and the less that's left to Treasury to figure out in regs, the better. I did, as you mentioned earlier, I did assist somewhat in an unofficial capacity, reviewing and adding suggestions. I would also say that there was only one draft of the proposals publicly released, and that I think if people saw a follow-up version, the number of the issues that have been raised would be addressed. I haven't seen that myself, but I just know from comments that have been made and things I've heard that I think that would be true, and that this be given an objective and fair hearing when the time comes. I would hope sooner rather than later.
Monte, thank you so much for talking with us today, with sharing your knowledge. I think it's been very interesting, and I know it will be well received. So thank you.
Anytime.
For those of you watching and listening, thank you so much for joining us today. You can find my articles, blog posts, videos, and more at taxnotes.com. If you'd like to reach out to me, you can find me at ben.willis@taxanalyst.org or on Twitter @WillisWeighsIn. Want more like this? Subscribe for more tax videos. Special thanks to our executive producers Jasper Smith and Paige Jones, and showrunner and video editor Jordan Parrish.
Willis weighs in.